Welcome back to The Deep Dive, your shortcut to being well-informed. Today, we're tearing into the latest earnings report from Buckle, that's ticker BKE, for their second quarter of fiscal 2025. Our mission, as always, is to cut through the noise, pull out the key nuggets, and really understand what's going on with their performance.
Yeah, and heading into this call, expectations were generally, I'd say, pretty constructive. People expected a solid quarter, but frankly, these results, they didn't just meet expectations, they beat them quite handily in some key areas.
That's an interesting stage, doesn't it? Especially in this retail climate.
Exactly.
Okay, let's jump straight into the headlines then. Buckle really did put up some fantastic numbers, significantly outperforming what the market was looking for.
They certainly did. The numbers are compelling. GAAP earnings per share, EPS, came in strong at $0.99.
0.99 cents, okay. And the consensus was?
Consensus was looking for 0.83 cents, so comfortable beat there. And then on the top line, revenue also saw a really solid beat, $305.7 million against a $292.6 million consensus.
Wow, okay. That's quite a jump year over year too, right?
It is an impressive 8.3% increase compared to last year. Really signals robust demand.
An 8.3% revenue jump is definitely noteworthy right now. But what about the underlying sales drivers? Where did that growth actually come from?
Well, it was pretty broad-based, which is encouraging. Comparable store sales increased a solid 7.3% year over year, so good health in their physical stores.
Right.
But the real standout, e-commerce, it absolutely shined. Jumped, get this, 17.7% to $43.6 million.
17.7%. Okay, that's significant digital
It
traction.
really is. Highlights their omni-channel approach is paying off. And beyond the sales, we also saw strong margin expansion. Gross margin was up 50 basis points to 47.4%.
Okay, and maybe just quickly for folks listening, 50 basis points, that means?
Good point. Basis points are just hundredths of a percent. So 50 basis points is 0.5%. Might sound small, but at their scale, 0.5% on gross margin. That really adds up on the bottom line.
Makes sense. And operating margin?
Also improved. Reached 18.4% compared to 17.1% in the prior year. So more profitable operations overall.
Okay, fantastic headlines. Let's unpack this a bit more then. What was really driving those robust sales figures? Any particular categories standing out?
Oh, absolutely. The undeniable star really was the women's business. Merchandise sales there accelerated to an 18.5% increase year over year.
18.5.
Yeah, and it now represents about 47.5% of their total sales. So a huge driver for the whole company.
And within women's, anything specific?
Denim. Women's denim surged by an even more impressive 20.5%. And what's really interesting here is the average price, the AUR for women's denim, also increased, went up to $85.35 from about $80.60 last year.
So not just selling more jeans, but selling more expensive jeans.
Exactly, which they attributed to strong growth in their own premium line, Buckle Black Label, and some other higher-priced national brands they carry. Shows customers are trading up.
That's a powerful signal. And, it gets really interesting when you look at some other areas, too.
Yeah.
Like the kids' business and that continued push in private label.
You're absolutely right. The kids' business, which sometimes flies under the radar, had a fantastic summer. Grew approximately 23% year over year.
23%.
Yeah. Now, it's still a smaller piece of the puzzle, about 4.5% of total sales, but that kind of growth shows real potential. But the private label story, that's really something. For the 10th consecutive quarter, private label grew as a percentage of their mix.
10th quarter in a row.
Yep. Reached 43.5% of sales this quarter.
That's not just a trend. That feels like a core strategic advantage, doesn't it?
It absolutely is. This sustained growth is crucial. First, for margins, because private label usually carries higher margins. But second, and maybe more importantly, it shows their growing product authority. They're becoming less reliant on outside brands and more able to set the trends themselves.
Right, building that brand loyalty directly.
Precisely. It creates a real competitive advantage. And hey, even the men's business, which had been lagging, returned to growth. Up 1.5%, led by a nice 4.5% increase in men's denim.
Okay, so strong revenue fueled by key categories. But the margin expansion is where it gets really impressive in this environment. How did they pull that off? What was the secret sauce there?
It really came down to smart merchandising and tight cost control. Let's start with gross margin, that 50 basis point expansion.
Yeah, to 47.4%.
Right. primarily driven by a 10 basis point increase in the actual merchandise margin. They said this was thanks to strong full price selling.
Meaning fewer discounts needed.
Exactly. Selling more stuff at its intended price. That's always a good sign. Plus, they got about 40 basis points of leverage on costs like buying, distribution, and rent, basically getting more efficient as sales grew.
Okay, that covers gross margin. What about SG&A?
Yeah.
The operating expenses. That's often where costs creep up.
You're right, and this is where Buckle really delivered. They managed an 80 basis point reduction in SG&A as a percentage of sales, down to 29.0%.
80 basis points is significant there. How'd they do it?
Well, a big chunk, 65 basis points, came from something they called lapping non-recurring digital commerce investments.
Okay, lapping non-recurring investments. Let's translate that quickly. What does that actually mean for this quarter's results?
Good question. It basically means last year they spent a chunk of money on a one-time project, likely improving their website, buckle.com, using consultants and third parties. Think of it like a big upgrade you only pay for once. So this year, that expense isn't hitting the books again.
Right, so compared to last year, their costs look lower simply because that big one-off expense is gone.
Exactly. It makes the year-over-year comparison look very favorable on the cost side. Beyond that, they also saw a 45 basis point decrease in store labor costs and a 55 basis point decrease in other general admin costs. Now, it's worth noting these savings were partly offset by an 85 basis point increase in incentive compensation accruals.
Which sounds bad, but actually means
Good things are happening. It suggests employees are hitting performance targets and earning bonuses, which is usually tied to strong company performance.
Got it. So strong sales, better product mix, like more private label, and that disciplined cost control, including lapping those investments. That all combined pushed up the operating margin.
Precisely. All those factors work together to get that operating margin up to an impressive 18.4%. Really strong execution.
Okay, moving beyond the profit and loss, let's talk balance sheet and capital allocation. How's the company looking financially, and where are they putting their money?
They ended the quarter looking very healthy, had about $349.6 million in total cash and investments, lots of flexibility there. Inventory stood at $142.5 million. Now that's up 8.4% year over year.
Is that inventory build a concern?
Not really, because it's pretty much in line with their sales growth of 8.3%. It suggests they're managing inventory well, not just piling up unsold goods.
Okay, strong cash, controlled inventory, good foundation. How are they deploying that capital? Store growth, remodels.
A bit of both, but seemingly quite strategically. They spent $12 million on capital expenditures in the quarter. They maintained 440 stores across 42 states, which is the same total number as last year.
So no net change in store count.
Right, but there was activity within that count. In Q2, they opened 2 new stores, completed 4 full store remodels, and one of those was actually relocating to a better spot in an outdoor center, and they closed 1 store.
So optimizing the footprint, it sounds like.
Exactly. Investing where it makes sense. And they plan more for the rest of the year, opening 4 more new stores and completing another 12 full remodels. This investment, by the way, ties into why occupancy costs were up a bit in Q2. These projects, especially moving to better locations, can mean higher base rent. And when sales are strong in those stores, percentage rent kicks in too, which, is a good problem to have.
Paying more rent because you're selling more stuff. Okay, shifting gears slightly to customer behavior. The transaction metrics were pretty interesting, weren't they? Almost seemed a bit counterintuitive.
They really were. This gives you a peek into how people are shopping. Units per transaction, or UPT, basically how many items people buy per visit actually decreased slightly by about 1.5%.
So people bought slightly fewer items each time they shopped.
Yeah, on average. But, and this is the key part that was more than offset by a 3% increase in average unit retail, AUR, the average price per item.
So fewer items, but higher prices per item.
Exactly. And the net result was a 1.5% increase in the average transaction value, or ATV, the total amount spent per transaction.
So what does that tell us? Fewer items, but higher prices leading to a slightly higher total spend per visit.
It's a very positive signal, actually. It suggests strong pricing power for Buckle. Customers might be buying one less t-shirt, perhaps, but they're opting for that more expensive pair of Buckle Black Label jeans instead. It points to that favorable product mix shift towards their premium and private label offerings we talked about. They're successfully getting customers to choose higher value items.
Makes sense. Finally, looking ahead, did management give any guidance? Or Talk about macro stuff like tariffs.
Well, Buckle has a long-standing policy. They don't provide future sales or earnings guidance. They stick to the safe harbor provisions there.
So investors are flying a bit blind on official forecasts?
Pretty much. You have to rely on their track record, current trends, and your own analysis. On tariffs, though, they did comment. They noted they're seeing low to mid-single-digit cost increases on average from their vendors. Some specific brands a bit higher, maybe high single digits.
But is that hitting their pricing?
Apparently not much, at least through Q2. They said tariffs had minimal impact on their average unit retail prices. So they seem to be managing those cost pressures effectively for now, whether through negotiation, absorption, or sourcing changes.
Okay, so let's put all this together. What does this really strong Q2 mean for you, the investor, and maybe for the broader retail picture?
Look, these results really showcase Buckle's execution strength, especially in what's still a pretty tricky environment for discretionary spending. Their ability to deliver beats on both the top and bottom lines, expand margins significantly, and show strong growth in key areas like women's denim and private label.
Yeah.
It really stands out.
Yeah, it feels almost counter-cyclical in some ways.
It does. And the market certainly noticed. The stock popped 2.6% on the day of the call, closing at $56.26, and trading volume was way up, nearly double the average. That suggests real investor confidence.
And how does Buckle stack up against the wider retail sector?
That's another key point. They've been significantly outperforming the broader retail ETF XRT. If you look at the past month, 3 months, even the last year, BKE has beaten XRT pretty handily.
Like how much better?
Well, just as one example, BKE's 1-month return leading up to this was around plus 14.4% XRT over the same period. Only plus 4.35%. That's substantial outperformance.
Okay, so that naturally leads to the question, what are the potential catalysts moving forward? What should investors be watching?
Right. Key things to watch will be their continued monthly sales updates, especially heading into back to school and the all-important holiday season. Also, the ongoing impact of those store remodels. Are they driving sustained traffic and sales lifts? And then there's the capital return angle.
You mean dividends?
Exactly. Given their strong cash position and their history, remember that $2.50 special dividend they paid out last December. Some investors are likely anticipating another potential special dividend later this year. That could definitely be a catalyst.
Okay, makes sense. Now, as always, this is not financial advice, but we do like to toss out a strategic thought experiment, an outrageous but plausible trade idea based on what we've discussed.
Right. So considering Buckle's consistent outperformance relative to the sector and that historical pattern of potential December special dividends, here's a thought. You could construct what you might call a dividend plus alpha pair trade.
Okay, break that down.
The idea would be to go long Buckle stock, BKE. You're betting on their continued operational strength, that favorable product mix, and the potential catalyst of another special dividend. But retail is volatile, right? So to hedge some of that broader market risk, you could simultaneously take a smaller short position in the retail ETF, XRT.
So long BKE, short XRT.
Exactly. The goal is to capture Buckle's specific outperformance, its alpha, and that potential dividend boost, while trying to neutralize some of the general ups and downs of the retail sector itself. Interesting. A bet on Buckle specifically hedged against the overall market noise. Precisely. It's definitely a specific bet on their execution and capital return policy, but it's grounded in their recent performance and history. A bold idea, for sure.
All right, so wrapping up our deep dive on Buckle's Q2 2025. We saw impressive beats on earnings and revenue, strong margin expansion, and really strategic growth in key categories like women's wear and private label.
Yeah, their disciplined execution, strong financials, and smart strategies, especially around denim and their own brands, are clearly paying off. It's led to that significant outperformance versus their peers. Really makes them a company to watch.
We hope digging into these details helps you shape your understanding of the retail landscape and where Buckle fits in. Maybe even spark some thoughts about what makes them different.
And just one last reminder. That trade idea, purely a thought experiment for discussion, not investment advice.
Absolutely. Thanks for joining us on the deep dive for this look at Buckle. We look forward to our next conversation.